and welcome to this edition of Taxtixs. Today, you are joined by myself, Kelly Power, and Tim Humphries.
Oh.
And we're just going to have a bit of a end of the summer roundup, really, aren't we, Tim?
Yeah, a bit of a catch-up, yeah.
Yeah. It's been a few weeks, what with holidays and so on. So really, we're just looking at some things that have cropped up in the news. So not necessarily developments as such, but thoughts on what might happen. I think since we last had an edition of the podcast, we've got a new Prime Minister.
Chancellor.
Indeed. Got a date for the budget set.
Yeah.
Don't we? There's been speculation about what the budget's going to bring. So we're going to talk a little bit about that. And also just a couple of other points of interest that have arisen. So first of all, the new Chancellor's suggestions for tax changes and what that's going to mean for businesses and so on.
Yeah.
Your side.
Sure. I think the general gist of what they've been saying is essentially we're going to stop taxing earned income and try and tax passive investment income or wealth, whatever you want to call it.
Mm-hmm.
So they made a pledge in the manifesto not to raise VAT, employees insurance or income tax. But I think they've already sort of carved out a little bit, say income tax on earnings rather than investment income, considering they've already announced in the last budget they're going to be raising income tax rates on dividends and rental income and things like that. So I'd suggest along those lines, if they're going to be trying to increase the tax take, all that's really left really is a raise in CGT rates. I mean, we've been sort of thinking about that for the last few years, whether they're actually going to do that, but now might be the time that they actually get around to doing that. So I'm kind of anticipating that we will see an increase in CGT rates back to potentially the same as income tax rates. I think people sometimes forget we had that under the last Labour government back in sort of the early 2000s. That was the case, that income tax and CGT rates were the same. But at that time, we had something called taper relief, which meant the longer you held an investment, or if it was a business investment, you were able to reduce that rate down. And I've got a funny feeling we may see an reintroduction of a similar thing where they might benefit some entrepreneurs to keep that entrepreneur's sort of spirit going, to reduce their CGT rate on company sales, things like that. But passive investors, I can see they may well feel the full force of income tax rates going forward, seems to me. Direction of travel.
There was also something else I read about potentially taxing through council tax owners of properties that are worth more than 2 million as well. So probably going at the higher end of the market. Again, just a suggestion, I think, at the moment.
Yeah, I mean, there's sort of having a property value tax, so scrapping council tax altogether, and sort of having more of a wealth tax in that respect, so that you pay more council tax. More your property's worth. The local governments and places that got the higher value properties will get more money, and the people that really need the money won't have it. So it doesn't really. You'd probably need some rebalancing or bans that move depending on where you're in the country to make that work. Really, but,
I think one of the things that they've said is that they want to put money back into people's pockets, which you kind of wonder, well, how are they going to do that when they're sort of have got such large deficits everywhere. But one of the things they've already announced is to cut VAT completely on domestic supplies of electricity from 1st of October. So it's not going to be a huge amount, but it's still going to make a difference to everybody. That's to be welcomed.
Assuming the utility companies pass that on, presumably.
Yeah, well, I think they would need to, because they would move domestic supplies of fuel into zero rating rather than reduced rating. So they would have to, but unsure why it's not going to apply to gas as well as electricity. That seems a bit bizarre.
Right.
But then there's also a suggestion that, and something we've talked about on the podcast before, public charging of EVs, currently at 20%, although there was a VAT case a few months ago, which saw that potentially that could be subject to the reduced rate if those providers of the EV chargers could demonstrate that the use was under the domestic threshold of kilowatts per month and some technical details like that.
Yeah, interesting.
Exactly. So if you're not lucky enough to have a drive and somewhere to park and charge your vehicle on your own property, then it sort of puts you in level playing field.
Yeah.
But that isn't across the board. I think the court case, the tribunal decision was just that potentially that could apply if certain conditions were met. Again, a call for that to be a wide-ranging change across all public charging of EVs. that would sort of
That
sit
makes
well
sense,
with
yeah.
the removal of that entirely from domestic fuel as
Mm.
well. I suppose following hot on the heels of the summer VAT savings and, reduced rates for hospitality and leisure, etc., over the school summer holidays, looking just to extend that more broad, which would be a welcome bonus.
To that sort of hospitality and leisure sector, yeah, really been struggling of late with
Yeah.
high rates and things.
Yeah, and something that is done across Europe. So, it would make sense to reduce that across those things.
Indeed,
You just
yeah.
mentioned across the hospitality sector, business rates as well.
Yeah, business rates are likely to be looked at, aren't they? Yeah, so help sort of the smaller pubs and cafes and things. Yeah, I think that's a welcome change if they do go and look at that, because it has been a bit crippling, as I understand it. The rates seem to have gone up and up and up. Minimum wages going up, which affects that kind of industry a lot as well. So, the costs are going up and up. So obviously they've got to pass that on to the consumer, and if they don't live in an area where they can afford to take those costs, and they're struggling. So yeah, it's sort of creating that level playing field by evening out those sort of things in the tax system.
Yeah. So we shall see. We shall see what changes are in store. Post-budget webinar where we'll be sort of going through the detail of changes once we know
Yeah, the
what they
following
are.
Monday. Yep, after the budget.
Other changes then, I think we were talking earlier, Tim, there's been a couple of interesting tax cases which...
Yeah. There's been a few actually in the last few days, in fact. So one I was just been looking at recently was the Pontins case. I got a bit excited thinking that was about holiday homes, but no, it's just that happened to be the surname of this family that had sold this company. So effectively, Mr. Pontin, his wife and 2 kids owned a company. It had a property inside it in Henley-on-Thames, and it was just rented out to start with. So they've just had rental income. At some point in around 2011, they decided that to really benefit from owning this property, they were going to convert it into residential flats, effectively. And then about a year later, they entered into an option with a company who had said they would buy it if they were able to achieve all the planning permissions necessary in that part of the world. And so they sort of get into Oxfordshire Council's neighbourhood scheme, which was to do sustainable developments. So Mr. Ponting went out and spent all of his working time trying to get the right planning permissions, figure out what he needs to do with the property, getting into this neighbourhood scheme, and spent basically all that. In the meantime, there was a bit of rental income coming in because they did have this property. It was empty, so they rented at least part of it. And the question was, when they then sold this in June 2016, was that the sale of a trading company or of an investment company? So if it's just rental income, that's typically investment. But if you're a property developer, then that's going to be a trading activity. The legislation specifically looks at preparing to trade, also accounting, when it comes to selling a company and qualifying for the reduced capital gains tax rates, entrepreneurs relief as it was called at the time.
So preparing to trade would have the same tax consequences as actually trading.
Correct, yeah. Right. And it specifically spells that out in the legislation, that it's trading or preparing to carry on a trade. And the tribunal kind of made the point that, preparing to carry on a trade must qualify, and the activities they were doing, preparing the groundwork, as it were, to actually get the property built, must qualify, otherwise Parliament would not have specifically included that in the legislation. So they did highlight that particular point. And in the end, they sold the company before the property was built. So that was kind of key. So up to the point they sold it, all they had done is receive rental income. But the legislation talks about activities, not about income. So as long as your activities are trading activities and not to a substantial extent non-trading activities, then you can qualify for the reduced rate of capital gains tax. Now, HMRC, as they have done in a few cases, focus on the income and perhaps even the asset without really thinking about the activities. The amount of time that Mr. Pontin and the effort he went into putting to get those planning permissions to get the thing up and running was vastly significant compared to just signing off a couple of leases and getting some passive rental income each month.
In the meantime.
Exactly. So firstly, tribunal saw sense and said, no, of course that's trading. Ultimately, that property was sold for a £25 million profit, but that was not under their ownership. They sold the shares in the company and then the company. But it was interesting that they did actually look what happened in the future after the sale, which you kind of think they wouldn't, because it's the point of sale that you have to do the tests. Hindsight's a wonderful thing. So I think they did use that in that particular case. Guarantee it in all cases.
They had the luxury of doing that because it took so long.
It took 10 years from sale to reach the decision. Because it's based on one particular technical point, it just seemed an inordinate amount of time to come to a conclusion on that.
Yeah.
It was a bit ridiculous. It could easily have, been decided, and frankly, a couple of letters to HMRC.
Yeah.
I don't know why they needed to drag that out. I feel like that's HMRC's wrongdoing. It was a fairly obvious outcome in my eyes from what I've read of the case.
From what you've explained, the legislation talks about preparing to trade, and clearly that's what they were doing.
Yeah, I just don't think that HMRC just don't like property, to be honest. They try and get as much money out of it as possible, to be honest. So I think the fact it was a property just didn't help. So they considered it non-trading. Look, to me, it was clearly a trade. If you've documented your intention, they had everything. It was all obvious from the witness explanations as to what they were doing.
Yeah, it's an interesting one, isn't it? And it's just such a shame that it takes so long for HMRC it to be appealed to tribunal.
Yeah, exactly. And then the tribunal, it takes a while to get through that whole system as well. So it's, it just seems a bit of annoyance of the tax system that it can take 10 years to basically get to an answer. Anything could have happened in that time. So it feels like the tax system is supposed to give you certainty. It shouldn't take 10 years to reach certainty.
Yeah. And I suppose in this case, there was the benefit of hindsight, wasn't there? You could see that actually those developments did come to fruition and were then sold. And so there was a clear sort of narrative towards the end conclusion. Yeah. But if that hadn't been the case, might it have been decided differently?
I mean, it's possible, yeah. So they did actually refer to that future sale and sort of looked at how much they sold it for and the profit it made. But to my mind, that's not really a relevant factor. No. The question is, what were the activities in the year? Because at that time it was a year, now it's 2 years. The year leading up to the actual sale, what were they trading in that particular year?
Yeah.
And whether they then sold it, or whether if the new owners had decided to not sell it and just rented the entire building out again, doesn't mean you weren't trading. That's really a relevant factor. But if they help them reach the right conclusion, then so be it.
Yeah. Interesting case. Yeah, when we spoke about this earlier, that case is on slightly different, but you can sort of draw parallels. The TOGC provisions, transfer of a going concern, where if a business is transferred as a going concern, then it's outside the scope of VAT, because the idea is that the government wants to keep business running and they don't want to tax a business that is, just trading essentially. Whereas if you sell underlying assets, obviously that's going to be taxable in its own right at each liability of those assets. And there have been cases where business has been transferred and the taxpayers argued that there's been a transfer of a going concern and therefore outside the scope of VAT. And in those instances, again, it was just land that was really the physical asset, but it did end up being a transfer of a going concern because the business had invested all this time in seeking planning permission, getting planning permission agreed. They hadn't actually gone on to develop the property, but that was all in progress. And the transferee was in receipt of something that could be then the business of developing dwellings, whatever. And that's been accepted now. But again, HMRC didn't like that.
No, but it's as if they don't accept it unless the spade has gone into the ground and you start talking about the amount of work that goes into the lead up to reach that point, and the tendering or the planning permission and the legal fees and the advice you need before you get to that point.
We can take years, can't it?
Well, exactly. Yeah, I think HMRC seems to just think it's magic that these buildings just turn up.
Yeah. Talking about land and property, actually, capital goods scheme. So in VAT, you can create capital goods scheme assets if you carry out refurbishment of a property where the value breaches a certain threshold, or if you acquire property. Up until 29th of July 26, that threshold value was 250,000. And what that meant for taxpayers was that if you create a capital goods scheme asset, it then takes on a fictional life of 10 years. And throughout that 10-year life cycle, you have to adjust for VAT depending on the use that you put the asset to. So if you are using it for exempt purposes in year one, you don't reclaim any of the VAT. If you then change and start putting it towards a taxable use, you can then claim an amount of VAT in year two, and so on for the 10 intervals of the asset's life. But in order to fall within that regime, you need to breach the threshold, which was previously 250,000. So if you kind of step back and look at it, really, what property can you acquire for less than 250,000? Decades ago, that limit was put in place.
So what's the new limit now?
So the new limit now is 600,000. So I still think that probably for most property acquisitions, they would all fall within the CGS scheme.
Yeah.
maybe refurbishments now wouldn't necessarily, because that, it would have to be a fairly significant refurbishment.
Sure.
Yeah. So basically, from an admin perspective, if you have acquired land or completed a refurbishment after the 29th of July, the threshold is now 600,000, excluding VAT, compared to the previous 250,000. So just something for businesses to be aware of. Slightly more interesting and a bit of a tandem, a bit of a random sort of thought here, but HMRC have recently, within the last month, sent a letter to many. This is how we think the VAT legislation should apply to a given scenario and how you should be treating it. And what they did was they sent this letter to people who were generating income from receiving payments to enter a prize draw. So I enter into a prize draw, and I have the ability to win a set of golf clubs or a house in Cornwall or something like that. And it's just a bit of a strange and an interesting one, because I haven't seen any cases come out on this recently. And the legislation seems to be very clear that the right to take part in a lottery is VAT exempt. The legislation doesn't define what a lottery is. VAT notice does, and it says that a lottery is the distribution of prizes by chance, where the persons taking part make a payment or consideration in return for obtaining their chance of a prize. And that is what they define as a lottery.
So it doesn't involve extracting your big money balls to...
That's
not a lottery. That's not involved.
Well, it can be, but it can also be that it could just be a raffle, really. So what there's in this letter, what they're effectively saying is that they consider payment to enter a draw, the result of which will be a prize, is going to be subject to VAT, which seems to be a direct contradiction to the legislation. Maybe this is going to talk to my viewing habits on social media, but I am being spammed constantly by pay X amount and you could win this £4 million property in Cornwall, or whatever it may be.
You see a lot of those draws.
I wonder whether HMRC just want a piece of that pie and want to be saying, actually, this is subject to that. But I just can't see the legislative basis for that. And I can't see there have been any cases.
There's an interesting one. Because you think, prizes are always typically outside the scope of tax. So I guess that's their best option. It's normally problem with taxing. So the winners themselves don't get taxed on these prizes, because if you were taxed on the winnings, you'd be able to claim the losses on the fact you chucked your money in the first place. So generally you can't. So that's why they don't get taxed. So I guess that's their attack on these things, isn't it?
There are separate exemptions for charities and fundraising for charities. So if you're not a charity, but you're just doing this as a commercial enterprise, and they seem to be suggesting something else. So it's an interesting one, and watch this space, maybe. Anything else on your side, Tim?
There was one last one. There's a firm that had been promoting, effectively what they do is they help people incorporate their property businesses. So there's a firm called Property 118. They have been doing some just generic property incorporations. A couple may own 10 properties, let's say, but they realise they may be better off inside a company because they can get interest relief on their mortgages and they don't need all the money to live off, so they can accumulate the wealth inside a company. And that works. We advise on such things as well. They then took that one step further and said, well, when you put the properties into the company, you can also then create a loan account. Effectively, the company would owe them money back for having put the properties in the company. Normally, if you do that, that's treated as a sale and you'd be taxed on that. But they found a way that they thought that you'd be able to do that and still be able to extract money out tax-free. At that point, it becomes a tax scheme in the eyes of HMRC, at least. So HMRC reached out and said, you have to register as a tax scheme. One of the benefits HMRC of doing that is that HMRC can then go back up to 20 years to anybody who participated in this and say, right, we want to investigate what you've done. If it's not a tax scheme, they typically only have either 1 or 4 years to open the inquiry into that. So it helps them extend their window if they've missed anything in the past. And it also means anyone who does it has to tell HMRC. Otherwise, that in itself is an offence as well. If you don't tell HMRC you've done a scheme that's registered.
And are these schemes listed out, or is it just if you're taking part
Not publicly.
So-
So they're listed. So HMRC would have a list. So everyone gets a reference number, and then you would write that reference number on your tax return. And HMRC would look down and go, "Oh yeah, that one,
You
okay."
do that
And they
one.
would have a lot of detail behind that number.
Yeah.
To register it, you have to tell them exactly how you believe it works. But if you don't register it, they can still appoint you a number, as I said, because it then gives them some additional powers of investigation. Property 118 said, "We don't like this. You've given us a reference number. We don't believe this is a tax scheme. This is just legitimate. We're moving properties to company. Loads of firms in the country advise on that. Why are you attacking us for this?" So they went to a tribunal to get rid of that reference number. Some say, surprisingly, they actually won that case. They said the tribunal concluded that this was not a tax avoidance scheme. At no point in this tribunal decision did anyone mention whether it works or not. No one who has actually done this planning has gone through the tribunal system yet to see if you can actually create this loan that you can then draw down on tax-free. So we don't know the answer to that question yet. But it was just interesting that HMRC were rebutted and said, no, that's not a tax avoidance scheme, even though on the face of it, you've moved something and not paid tax and been able to draw money out of the company tax-free. Sounds a little bit like you're not paying all the tax that probably should be due in that scenario.
Yeah.
Some clever stuff behind the scenes on that, and that I'm not privy to every last detail of how it works. So yeah, no, it was just interesting. Obviously, Property 118 have come out and said, look, that's fantastic. We know it works, and they're full guns blazing again and promoting there.
Right. Well, that's a bit of a leap ahead, though, isn't it? Because as you said, the tribunal haven't said it works. They're just saying that they don't need to notify the scheme.
Indeed,
it's not a notifiable.
It's not a notifiable scheme,
Yeah.
correct? Yeah. So there'll be plenty more of that to come, I'm sure. I'll be very surprised if HMRC don't appeal that decision. The reasons given by the tribunal were not particularly clear or logical in places.
Right.
So I think HMRC would be appealing that one. And as I said, that's just whether you get a reference number. The actual scheme itself will definitely be going to a tribunal at some point. So.
Yeah. Well, now it's squarely in their radar.
Oh, for sure. Yeah, it's been an interesting summer so far. Well, different cases are coming out, different announcements, and obviously the budget to come. So we'll watch this space.
Yes. Thank you for joining us and this edition of Taxtixs, and we'll see you again soon.